Welcome to Talk Tickers, your essential summary of the biggest earnings calls impacting the market. Okay, let's unpack this. Today, we are diving deep into the recent fiscal Q2 2026 earnings report and conference call for Dynatrace, ticker DT.
Yeah, this was a really interesting one. The call itself, it gave some strong validation for their whole observability platform idea. We saw significant financial beats, raised guidance, really solid stuff.
There's always a but, it seems.
Well, yeah. The immediate market reaction was, let's say, volatile. It popped and then faded pretty hard. So it suggests investors are maybe struggling a bit to square those strong fundamentals with, where the stock was already positioned.
Right, that volatility is key. You see a big beat, raised guidance, and then the stock just sort of fizzles intraday. That definitely tells you something's going on beneath the surface. So our mission today is to distill those core numbers, management story, the strategy, and try to figure out what that disconnect might mean for investors looking at DT.
Okay, let's start with the result snapshot. It was fundamentally a clean double beat for their Q2.
Give us the numbers.
Non-GAAP EPS, it came in at $0.44. That beat the consensus estimate of $0 to 41 cents.
Okay.
And revenue did the same, $493.9 million, which was ahead of the $487.3 million expected. So a nice beat on both top and bottom lines.
Those are solid headline figures. What about the underlying growth, ARR, subscription revenue? How did those look?
Good question. Annual recurring revenue, ARR, hit $1.899 billion. That's up 16% year over year in constant currency.
16% ARR growth.
And subscription revenue was right there with it, up 17% on the same basis. So pretty consistent growth story continuing there.
And the immediate result of hitting these numbers, especially after a strong first half, was they boosted their full year guidance, right?
Exactly. They bumped up the outlook. That's always a clear sign of confidence from management, fueled by that solid execution they've been showing.
So what's the new target for the year?
Full year non-GAAP EPS guidance is now $1.62 to $1.64.
Oh.
And revenue guidance was also raised. Now they're expecting $1.985 billion to $1.995 billion for the full fiscal year. It's not just a tiny nudge. It reflects that they see strength continuing.
That brings us nicely to the deeper financial drivers. Beating revenue is one thing, but showing operating leverage efficiency, that's crucial in software these days.
Absolutely. And profitability was, frankly, a major highlight. The non-GAAP operating margin hit 31%.
31%, that's well above expectations, wasn't it?
Significantly above their own guidance, yeah.
Yeah.
Management pointed to a couple of things. The platform's automation helps their own costs, plus they're getting leverage from focusing the sales team on larger strategic deals. So the revenue upside just dropped straight to the bottom line, pretty efficient.
Okay, let's talk cash flow, though. Free cash flow for the quarter was $27.8 million. That's only a 6% margin. Seems kind of low compared to that operating margin. Why the difference there?
Yeah, that's a good point to flag. Q2 cash flow was seasonally lower. Often happens with timing of collections, maybe some specific CapEx.
So a timing thing mostly.
Largely, yes. You really need to look longer term. If you zoom out, the trailing 12-month pre-tax free cash flow margin is still a very healthy 32%.
Yeah.
That's the number that really shows the underlying cash generation power, not just one lumpy quarter.
Got it. Okay, so moving past the headline numbers and the margins, let's talk about the engine that seems to be driving a lot of this. The Dynatrace platform subscription, the DPS licensing model, sounds like they hit a key milestone.
Oh, absolutely. This is where it gets really interesting. Management confirmed DPS has really taken hold. It's their all-in-one license, and it's working.
How widespread is it now?
It now covers half their customers, 50%. And even more importantly, it covers 70% of their annual recurring revenue. 70% of the ARR is on this new model.
Wow. Okay, so the bet that removing friction by offering a whole platform would drive more usage, that's paying off.
Paying off big time. The data they shared is pretty remarkable. DPS customers, they adopt 2 times the number of platform capabilities compared to the older SKU-based customers.
Double the features used.
And maybe even more telling, they show nearly double the consumption growth rates.
Double of the consumption growth, too. Okay, so once they're on DPS, they just use more stuff faster.
Exactly. It validates that whole platform consolidation story.
Yeah.
Get them on the easier license, and they expand like crazy.
And that ties directly into something you flagged earlier, the difference between consumption growth and ARR growth. Management spent time on this, right? Explaining what's happening kind of under the hood.
They did, and it's a crucial point for understanding the future trajectory. Total consumption growth in Q2 was actually tracking north of 20%.
North of 20%, but ARR growth was 16%, subscription revs 17%. So usage is growing faster than reported revenue. How does that work?
Right. Think of it like
Yeah.
buying credits for a service. The customer buys and starts using the capacity that's the 20% plus consumption growth. But Dynatrace recognizes the revenue, the ARR, ratably, sort of smoothly over the contract term as those credits get used.
Ah, okay. So that higher consumption today is basically future revenue that's already locked in. It just hasn't shown up in the main ARR growth number yet.
Precisely. It's like a leading indicator.
Yeah.
High usage today translates to higher reported revenue down the line. It takes time for those rates to converge because of the accounting.
And a big driver of that high consumption is one specific area you mentioned, logs.
Log management, yeah. It's still their fastest growing product category, growing well over 100% year over year.
Wow, double.
Yeah, and it's getting close to being a $100 million business just in terms of annualized consumption. And their angle isn't just storing logs. It's about unifying that data with traces and metrics for, faster answers without manually piecing things together.
That makes sense. All that platform usage feeds into the bigger strategic story, doesn't it? The CEO was talking a lot about moving towards autonomous operations using AI.
Yeah, that was the core theme, positioning Dynatrace as essential for this future agentic world, as they called it, where you basically have AI monitoring other AI workloads. And their argument is, to do that effectively, you need precise, reliable answers, not just a bunch of loosely correlated data points from different tools.
Which relies on their specific platform architecture, right? They mentioned Rail, Varscape, and Davis. Can you break those down quickly? What do they actually do?
Sure. These are kind of their key differentiators. First is Rail. Think of Rail as their unified data lakehouse. It's the foundation, takes in all the data traces, logs, metrics, without forcing you to manage complex schemas.
Okay, unified data store.
Then there's Varscape. That's their direct knowledge graph. It sits on top of Rail and basically creates a real-time map connecting everything, apps, infrastructure, dependencies. It understands the relationships.
So Rail stores it, Varscape maps it.
Exactly. And then the third piece is Davis. That's their predictive AI engine. Because Davis uses the clean connected map from Varscape, it can supposedly pinpoint the root cause of problems much faster, much more accurately. The goal is moving from alerts to answers and eventually to automated self-healing systems.
Okay, that's the vision. Is it translating into actual business? Bigger deals, pipeline growth?
It seems to be. They highlighted that seven-figure ACV deals, the really big ones, were up 53% year over year.
53% increase in million-dollar deals? That's significant.
Yeah. And the pipeline for strategic accounts over the next 4 quarters is up 45% compared to last year. So it does look like that focus on bigger platform consolidation deals is gaining traction.
And those big deals often depend on how well you play with others, the ecosystem integrations. What do they say about partnerships?
That story is getting stronger too. They announced a new multi-year collaboration with ServiceNow. That's a big one for enterprise IT operations.
Definitely. ServiceNow is huge there.
They also talked about an Atlassian integration, embedding production insights into incident management, like Jira service management.
Makes sense.
And on the developer side, which is interesting, they joined the GitHub Model Context Protocol Registry, or MCP.
GitHub MCP sounds technical. What's the benefit for a developer?
It basically speeds up debugging. It allows Dynatrace to feed its real-time data errors, performance, logs directly into the tools developers are already using in GitHub, like Copilot or code reviews. So less context switching, faster fixes.
Got it. Faster feedback loop from production back to the code. They also mentioned an AWS competency.
Yeah, they achieved the AWS Generative AI Competency, just another validation point, showing they're aligned with the major cloud and AI trends.
Okay, so lots of positive momentum, strong numbers, raised guidance. But let's circle back to that investor context. If things are going so well, why did management talk about a prudent outlook and mention timing variability for the second half? Are they just being conservative, maybe sandbagging a little? Or is there a real risk there?
That's the million-dollar question, isn't it? They gave 2 main reasons for that caution. First, because their pipeline is shifting towards those larger multi-product consolidation deals.
The ones that take longer to close? It's exactly. More complex, more approvals needed. So they're confident they'll land them, but predicting which quarter they land in is tougher. Increased timing variability.
Okay, that makes sense. What was the second reason?
The usual suspect. The dynamic macro and geopolitical environment. Particularly, they called out AMIA, so Europe, Middle East, Africa. Just acknowledging there's still uncertainty out there.
And this leads them to expect Q4 to be more back-end loaded than usual.
Yeah, they expect the ARR waiting in Q4 to be heavier than historical patterns, suggesting they think some of those big deals might slip toward the very end of the fiscal year.
Okay. Now, one metric that didn't move much was the net retention rate, NRR. It stayed flat at 111%. How do we reconcile flat NRR with that 20% plus consumption growth we talked about? That seems like a contradiction.
It does, and this is likely where some of the market skepticism comes in. Management addressed it directly. They emphasized that NRR is a trailing 12-month metric.
So it's backward-looking by nature? Right. It's a lagging indicator. It reflects expansions and churn over the past year. They argue it will take multiple quarters for the current high consumption growth to actually pull that NRR number up significantly. Their focus is driving DPS, driving consumption, because they know mathematically if usage is up 20% plus Berg, the NRR has to follow eventually.
It just takes time for the math to catch up in that trailing metric.
That's the argument.
So putting it all together, fundamentally bullish story, right? Clean beats, raised guide, incredible 31% operating margin, but the stock faded after an initial pop.
Yeah, it really suggests that maybe investor positioning was already kind of crowded or there were valuation concerns hanging over it. The market seems to be saying, great numbers, but prove it with the NRR. Dynatrace has lagged the S&P 500 and the IGV software index over the past year, so maybe the market needs to see that NRR confirm the underlying velocity before really rewarding the stock.
Which brings us perfectly to our This Is Not Financial Advice segment. Based on everything we've just unpacked, what's an outrageous but maybe plausible trade idea?
Okay, so given that key divergence, the accelerating consumption versus the currently stable NRR, and seeing how successful DPS has been, hitting 70% of ARR. Here's the thesis.
All right, let's hear it.
We're looking at a potential long Dynatrace position. It's predicated on the belief that this 20% plus consumption growth, especially driven by DPS and that booming log management business, creates almost unavoidable commercial pressure. Customers will have to true up or expand their contracts sooner rather than later.
So the bet is that the lag between consumption and recognized revenue, NRR, closes faster than people expect.
Exactly. We'd posit that the net retention rate could inflect upwards faster than the market or even management's cautious tone implies, maybe pushing past 115% in the next couple of fiscal quarters.
And if that happens?
If you get that NRR acceleration confirming the underlying growth, combined with those already demonstrated 30% plus non-GAAP operating margins, well, that should force a multiple expansion on the stock. It could help close that performance gap we saw compared to peers and the broader market once the NRR finally validates the consumption story everyone sees happening underneath.
Interesting. So the trigger is watching for that NRR number to finally tick up meaningfully.
That's the core catalyst for this particular idea, yeah.
All right, so just to recap, we covered the strong Q2 beats on EPS and revenue, the huge momentum behind the DPS licensing model driving higher usage, that triple-digit growth in log management, and the whole strategic push towards autonomous operations powered by Rail, Varscape, and Davis, plus the key partnerships.
Yeah, and the key takeaway really is that management seems confident, raising guidance based on leading indicators like that consumption growth and strong pipeline build, even while acknowledging the timing on closing those huge deals can be variable.
Definitely a lot to digest there. And always remember, everyone, this information is purely for educational purposes. Please do your own research. But here's a final thought to chew on. If Dynatrace's pitch about delivering answers, not just data, via AI-powered observability really resonates, and they can prove it helps companies automate and save money, does observability, especially a unified platform like theirs, stop being a discretionary IT spend and become almost mandatory when companies look to consolidate tools and manage complexity? Something to think about. Thank you for joining us for this deep dive on Dynatrace.